Howdy, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, March 26, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, how will the legislative process to extend and expand the Trump tax cuts impact asset markets? Our answers are: Republican leaders are nearing a deal to extend and expand the 2017 Tax Cuts and Jobs Act, the signature legislative victory from President Trump's first term, and hike the debt limit by $4 trillion per House Speaker Mike Johnson, who said the Senate is coming around to the plan. Senate Majority Leader John Thune said there's consensus forming around the $4 trillion debt limit hike, despite opposition from Republican Senator Rand Paul. Republican Senators Josh Hawley and Tommy Tuberville opposed the plan over potential Medicaid cuts. With the U.S. Treasury expected to exhaust cash by summer or early fall, Republicans aim to pass tax cut legislation by Memorial Day, racing against time and internal divisions. Thune set a deadline of the week of April 7th for the Senate to pass a budget resolution. Needless to say, there remains a lot of execution risk with respect to the legislative process to extend and expand the Trump tax cuts. If the House gets its way, there won't be much money left over for the expand part of the equation. This means the positive fiscal impulse from the plan will be limited in scope. In our view, this scenario caps upside risk in risk assets associated with the passage of the reconciliation bill. If, however, House Republicans cave to the Senate Republican strategy and adopt the current policy baseline to add trillions more in deficit finance tax cuts, then we could be on the brink of a Liz Truss moment in the Treasury market. The likely dramatic widening of term premium in the bond market would initially be very bearish for risk assets until it becomes very bullish once the Fed steps in and provides the QE markets likely require to avoid a global debt refinancing air pocket this year. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's regarding tax cuts. It says, hi, Darius. The research is quite extensive and impressive. Thank you. I was wondering, have you looked at tax cuts in the past from JFK Reagan and George W. Bush to see tax receipts from individuals and incomes and corporations have increased or decreased 3 to 5 years after the tax cut? So yes and yes. This is stuff I've studied extensively throughout the course of my career. So the key takeaway with respect to tax cuts, and this is a very politicized sort of discussion topic, because on one side of the aisle, you're blowing holes in the budget deficit. On the other side of the aisle, you're spurring growth and raising tax revenues. And like everything with respect to politics, the answer's usually somewhere in the middle. So let me draw a diagram to kind of illustrate what I mean by this. So I say the key takeaway with respect to tax cuts is, the economy grows nominally. We have population growth, we have productivity growth. Those factors of production generally cause the economy to expand. Credit is generally expanding. Obviously, if you have a budget deficit that's growing over time, that's going to be contributing to economic activity as well. So you generally have to expect that we're not going to see tax receipts from income or from individuals and corporations ever really decline unless you're in a recession. You need to see like a significant drawdown in nominal GDP growth to see tax receipts decline on, let's say, a year-over-year basis. So in terms of how tax receipts actually impact the budget and then ultimately impact the economy, let's use this diagram here on the chart on the right. Ignore the actual sort of legend on the chart or the headline on the chart. I'm just going to use the lines on the chart to illustrate what I'm trying to show here. So what a tax cut is the negative deviation from the baseline of projected tax receipt growth. And that negative deviation, which would be the area under the curve between the red line and the orange line, is what causes economic growth. Is what is contributory to economic growth, to the extent that the savings ultimately get filtered into and throughout the economy. And so let's imagine, hey, we're on this path here, the red line for tax cuts currently based on the deadline of the Tax Cuts and Jobs Act expiring on December 31st. Let's say this is how tax receipts would have grown in that scenario. The orange line scenario is effectively how tax receipts will grow if they expand the Trump tax cuts beyond December 31st of this year. And then the blue line in this chart, the blue line in this chart would be what would happen if they expanded the Trump tax cuts. Notice how the slope of each of these lines is positively sloped. So tax receipts will go up And what they'll tell you on Fox News or Fox Business is that, hey, see, we cut taxes and tax receipts went up. And of course, that will be true. But the reality is they will go up less fast than they were initially supposed to relative to current law, which will ultimately cause the budget deficit to be larger in the future than it is currently projected to be by most governmental and non-governmental agencies, particularly the bipartisan agencies like the CBO, the Committee for Responsible Federal Budget, the Yale Budget Lab, the Penn Ward Model. All these bipartisan think tanks believe that extending the Trump tax cuts will knock us to a lower slope with lower positive slope with respect to growing tax receipts. And then they obviously also think that expanding the Trump tax cuts will knock us to an even less positive slope. And so that's kind of how the tax cut policy works. And so going back to the question, when you go back and you study tax cuts in history, it's easy to get caught up in the fact that receipts continue to rise in the future. And what's missing from that kind of analysis, I would consider to be politically lazy analysis, is where would tax receipts have been had you not implemented these tax cuts? But also on the other side of that, where would economic growth have been had we not implemented these tax cuts? So there is a trade-off, there is a balance. And generally speaking, when you go forward and backwards in time, we don't have the fiscal concerns and the constraints that we currently have today. I would argue that tax cuts from JFK and Ronald Reagan were fantastic ideas, given the low level of deficits and debt that we had in the economy, much less so with respect to George Bush in terms of the level of debt. But we did start from a budget surplus at that time. So you can make the case that it was a great idea. Now we are starting with a deficit to GDP of 7% of GDP, which is a record non-war, non-recession budget deficit. And we're starting with a debt to GDP ratio that's over 100 and a debt to liquidity ratio that's already over 1, which is well north of where peer economies are. So these are issues. These deficit issues are essentially much bigger now. The impact of growing the budget deficit and growing debt, there's a much greater risk as it relates to the Treasury crowding out financial markets and crowding out economic activity from growing the budget debt, from debt finance tax cuts. And that's the issue. You can finance tax cuts, with economic growth, and that's essentially what they're going to argue that they're doing. But the reality is what we've learned from the previous Trump Tax Cuts and Jobs Act is that, yes, it was positive for economic growth, but it wasn't positive enough for economic growth to prevent the deficit from widening. And in our opinion, the same dynamic is likely to occur here, just given the starting point. So we'll wrap it up there. Darius Dell here, presenting our Macro Minute for Wednesday, March 26, 2025. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.